We got some welcoming inflation news last week and the bond market noticed, but the relief did not last long. Escalating tensions in the Middle East pushed oil prices back up and overshadowed just about everything the data had to offer. 2 steps forward, 1 step back. Good afternoon and welcome back to your Arizona Market Brief. It is hard to believe we are already approaching the end of July. Kids are heading back to school and we are right in the middle of monsoon season here in Arizona. Last week brought some surprisingly positive inflation news, but that was quickly overshadowed as negotiations between the US and Iran fell apart once again and new attacks sent tensions escalating. That theme has carried right into this week with both countries continuing to exchange jabs while the Strait of Hormuz remains restricted. As a result, the 10-year Treasury is opening this week at 4.59, testing that 4.6% ceiling. For those who are not familiar, the 10-year Treasury is typically the best real-time indicator of where mortgage rates are heading. Investors price mortgage rates off of that yield, so when that moves, rates tend to follow. Let's get into what took place last week. Here are your headlines. June brought encouraging inflation news with both consumer and wholesale prices coming in lower than expected. Consumer prices fell 0.4% for the month, helped by nearly a 10% drop in gasoline prices, while annual inflation slowed to 3.5%. Core inflation, which excludes food and energy prices, was unchanged from May and rose 2.6% over the past year. Wholesale prices also declined from May to June, helped by lower energy costs. So what do you need to pay attention to? The cooler inflation reading is genuinely good news, but I think it's more important to understand why it came in lower before we get too excited about it. The primary driver of the drop was oil prices falling in June when the peace deal was on the table and the market was pricing in a resolution to the conflict. That is a geopolitical tailwind, not an economic one, and as we have seen over the past 2 weeks, that situation has completely reversed itself. With tensions reigniting and the Strait of Hormuz restricted again, oil prices are moving back up, which means the relief we saw in this report may be short-lived when the July numbers come out. Now, with that being said, cooler inflation does take some pressure off the Fed to raise rates, and that is not nothing. The market is widely expecting them to stay on pause at their meeting later this month, which will give the right call given everything that is still in flux. But I would be cautious about reading this report as a sign that the inflation problem is solved. The Fed's dual mandate is price stability and a healthy labor market, and both of those are still very much at work in progress. The data the next few months produces is going to matter a lot more than this one reading. The bottom line is simple: good news on inflation, but the reason behind it is already reversing. Keep your eyes on oil. Now in housing news, housing starts bounced back in June, rising 19% after dropping to a 6-year low in May. The good news is that May number is looking more and more like an outlier, with June coming in above expectations at an annualized pace of 1.43 million homes. To put it simply, housing starts measure new homes that have officially broken ground and started construction. So with that rebound is a welcome sign for the supply side of the market. Now, on the flip side, building permits came in softer, declining 3% from May to an annualized pace of 1.37 million units. Permits are worth paying attention to because they give us a window into future construction activity. Fewer permits today means fewer homes coming to the market down the road. Now, despite the solid rebound in starts, builders are not exactly feeling confident heading into the back half of the year. The National Association of Home Builders Housing Market Index dropped 2 points in July to 34. Anything below 50 means more builders view current conditions as poor rather than good. And with affordability challenges, elevated mortgage rates, and higher construction costs all still in the picture, it is hard to blame them for that cautious outlook. So what is the bigger takeaway? This is the part of the housing story that does not get talked about enough. Even when builders are motivated to build, the pipeline from permit to finished home is long. Permitting, financing, construction, and completion before a single unit hits the market. That process does not speed up just because buyer demand does. And that is the problem. If rates move lower later this year, buyer demand comes back fast. New inventory does not. We have seen that play out before, and the result is always the same: more buyers chasing fewer homes and prices that respond accordingly. The supply picture is not building the case for a market softening. If anything, it is building the opposite one. Now, in other economic news, retail sales increased 0.2% in June, in line with expectations. Lower gas prices led to a decline in gas station sales, which pulled down the overall figure. However, excluding gasoline purchases, sales rose a stronger 0.7%, showing that the consumer actively remains resilient. Now, the labor market continues to show mixed signals. New unemployment claims remain relatively low at around 208,000, but they may not be capturing the full picture, as some workers who lose jobs are turning to freelance or gig work rather than filing for benefits. Meanwhile, continuing unemployment claims remain elevated at 1.81 million, suggesting it is taking longer for job seekers to find new employment altogether. This week is a quiet one on the data calendar, with only 2 reports worth noting. Thursday brings weekly jobless claims, and Friday closes out the week with June's new home sales report. Neither one is a market mover on the level of what we have seen over the past few weeks, so the real story this week is going to be playing out in the Middle East rather than in the economic data. If tensions continue to escalate through the end of the week and oil prices keep climbing as a result, expect upward pressure on mortgage rates to continue. Investors are watching the Strait of Hormuz situation closely, and any sign that the conflict is deepening rather than resolving is going to show up in the bond market quickly. We have seen how fast that happens and how much it can offset an otherwise encouraging inflation reading. With that being said, the next few weeks of geopolitical news may matter more for mortgage rates than any other single economic report on the calendar. I'll be in touch with a full breakdown next week. Have a great rest of your day.